Okay, here's something that might make you pause. We keep hearing about U.S.-China trade tensions constantly.
Been years now, right?
Exactly. But then the latest U.S. tariff announcement drops, and Chinese exports actually go up.
Yeah, that seems completely backwards, doesn't it?
It really does.
Yeah.
So today we're going to unpack that because that strange little fact,
Okay.
it really points to some much deeper things going on in the whole U.S.-China trade dynamic.
It absolutely does.
Right.
What looks illogical right on the surface, well, it actually pulls back the curtain on this really complex economic relationship. It's a tangled web.
Totally. So yeah, we're diving deep into the, let's say, the real mechanics of the trade situation today. We've looked at some really solid analysis.
Mm-hmm.
And the goal is to get past just the headlines. Focus on what's really driving things.
Right, because it's easy to get overwhelmed by all the back and forth, the announcements, the jargon.
So easy. Our mission here is simple. Cut through that noise, figure out what really matters, and hopefully bring some clarity. We'll look at the history, where we are now, and maybe peek down the road a bit.
And the sources we're drawing from give us a good foundation. They cover the starting point of the friction, China's counter moves, the ripple effects globally.
Everything.
Pretty much. We want to pull out those key insights and connect the dots in a way that hopefully makes sense for you listening.
Okay, sounds good. So let's rewind. Where did this latest round, or maybe even the whole thing, really kick off? What was the starting gun?
Well, the analysis we looked at points to a pretty dramatic opening move. The Trump administration hitting essentially all goods coming from China with a proposed 145% tariff.
Wow, 145%. That's not really a tariff. That's more like a blockade.
It was definitely aggressive. And as you might expect, it didn't stick at that level for long.
Right. I remember there was a quick walk back.
There was. Pretty quickly, an agreement was made to bring that down to 10%, but only for 90 days.
Okay, 10%. Still significant, but not 145.
Exactly. And importantly, that 10% didn't cancel out other tariffs that were already in place from earlier rounds. It was a specific temporary reduction on that big blanket tariff threat.
Got it. But underlying all this tariff talk,
Hmm.
what was the real reason? It wasn't just random, right? There were deeper concerns.
Oh, absolutely not random. The analysis really stresses this. The core issue, and this is something you hear from both sides of the aisle in the U.S., actually.
Mm-hmm. Bipartisan concern.
Right. It's about China's huge growth in manufacturing power. And the feeling in the U.S. that this growth is or could become a threat to, national security and economic leadership. This isn't new either. It's been building up for years.
And isn't there a kind of built-in tension there?
Yeah.
Because the U.S. economy relies so heavily on global supply chains.
And China is a massive, massive player in those chains. That's a critical point. It's a real paradox. You've got this push to counter China's economic rise, but at the same time, the U.S. system is deeply integrated with and often dependent on the efficiency and, frankly, the low cost of Chinese manufacturing.
It's like trying to untangle spaghetti.
A very accurate analogy. It's incredibly difficult to separate those strands cleanly.
So, okay, the U.S. applies pressure. How has China reacted? They obviously didn't just, take it lying down.
Definitely not. The analysis highlights a really key strategic shift China's been making, and this goes back maybe the last decade or so.
Okay.
They've been deliberately working to make their economy less reliant on exports driving all the growth, moving towards more domestic consumption, for instance.
That sounds like a pretty fundamental change. Do we have any numbers to sort of illustrate that shift?
We do. The data shows that back in 2018, exports specifically to the U.S. made up about 3.5% of China's whole economy.
Okay, 3.5%.
By 2023, that number had dropped to 2.9%.
Okay, that might not sound like a huge drop in percentage points.
Right. But when you think about the sheer size of China's economy, even a fraction of a percent represents a really significant amount of activity. It shows a conscious effort to rebalance to make themselves less vulnerable to, say, U.S. tariffs.
And maybe freer to pursue other global economic avenues.
Potentially, yes. It gives them more options.
So if they're depending less on the U.S. market, where is that trade focus shifting?
A major area highlighted in the analysis is increasing trade with the global south, countries across Asia, Africa, Latin America.
Okay. Any specific examples that stand out?
Yeah, the source mentions Cambodia and Vietnam specifically as really good illustrations of this trend.
Interesting. Let's take Cambodia first. What's the trade flow look like there?
So in 2023, China sent about $12.75 billion worth of stuff to Cambodia. Think fabrics, electronics components, machinery parts, Basically, inputs for factories.
Okay, materials going in.
Exactly. And then Cambodia exported about $8.9 billion worth of goods to the U.S., mostly clothes, shoes, finished products.
Ah, I think I see where this is going.
Right. The crucial part is that those Cambodian exports, they heavily rely on the materials and components that came from China in the first place.
So China's still in the picture, just one step removed from the final sale to the U.S.
Precisely. And you see a very similar pattern, actually even larger scale, with Vietnam.
Okay, what are the numbers for Vietnam?
In 2023, China exported a huge amount, $137.6 billion to Vietnam. Again, lots of electronics, steel, other industrial inputs.
Wow, that's a big number.
It is. And then Vietnam turned around and exported $118.4 billion worth of goods, largely electronics and clothing, to the U.S.
And again, presumably using a lot of those Chinese inputs.
That's the strong implication. The analysis even suggests that this is why you hear talk about the U.S. potentially looking at tariffs on goods from Vietnam or Cambodia, too. It's an attempt to get at those supply chains that still heavily involve China, even indirectly.
Man, it really shows how interconnected everything is. You can't just isolate one piece.
Not easily, no.
Okay, let's go back to the immediate effects of those U.S. tariffs. We mentioned that surprising initial increase in Chinese exports. What caused that bump?
Yeah, that 5.6% jump in March. The analysis says that was mostly U.S. companies basically panic buying.
Trying to beat the deadline.
Exactly. Stocking up on inventory before the higher tariffs kicked in. It's called front-loading.
So, a short-term surge driven by anticipating higher costs later.
Right. Which, put immense pressure on Chinese factories suddenly needing to ramp up production like crazy.
I bet.
And at the same time, China was publicly stating, okay, we're going to retaliate with our own measures. Plus, you started hearing worries from U.S. consumers about, prices going up and maybe not being able to find certain things.
Which brings us to that temporary 90-day tariff reduction back in May.
Yeah.
Why do that, and what did the analysis say about its likely effect?
Well, the likely reason for the temporary reduction was probably to ease some of that immediate pressure, maybe cool things down a bit, create some space for talks, perhaps.
A pressure release valve.
Sort of. But the analysis pointed out a potential, maybe unintended, consequence.
Which was?
That by lowering the tariff temporarily, it could actually widen the trade gap again in the short run. Because U.S. companies would likely resume buying more Chinese goods while the rate was lower.
Ah, okay. So it highlights how tricky it is to use tariffs to fine-tune trade flows. Can backfire.
It really can. Very complex tool.
Now, despite all this tariff pressure, something the analysis really hammers home is just how resilient China's manufacturing base is. Why is it so hard to just shift production somewhere else?
There are several big reasons. First, just the sheer scale. China has built up this massive manufacturing capacity over decades. It's not just factories, it's entire ecosystems of suppliers, logistics, skilled labor in certain areas.
Right, the whole network effect.
Exactly. Then there's efficiency. They've gotten incredibly good at making things quickly and, importantly, relatively cheaply.
And we got some numbers on profit margins too, right? Which were surprisingly low.
Yeah, very thin margins. The analysis mentioned that for large Chinese manufacturers, those with over $2.8 million in annual revenue, the average profit margin in 2023 was only around 5.76%.
Wow, that's tight.
It is.
Yeah.
And for some of the really huge suppliers, names you might recognize like Foxconn or Luxshare, who make tons of electronics for global brands, their margins were even tighter, somewhere between 4 and 7%. It just shows how hyper-competitive and cost-focused that environment is.
And it's not just about cheap labor anymore, is it? Automation plays a huge role now, too.
A massive role. China has invested incredibly heavily in automation. The analysis estimates they have something like 1.76 million industrial robots installed.
1.76 million?
Yeah, which is apparently close to half of all the industrial robots in the world.
That's staggering.
It is. So you combine these established networks, the labor costs, which are still competitive in many areas, plus this huge wave of automation. It creates a manufacturing powerhouse that's just very, very difficult and expensive to replicate quickly somewhere else.
And the implication is, if companies do try to shift production away significantly.
The analysis suggests costs will almost inevitably go up for U.S. consumers and businesses. It's hard to match that combination of scale, efficiency, and automation elsewhere, at least in the short to medium term.
And we're already seeing some economic consequences in the U.S. from all this, aren't we? Beyond just potential future price hikes.
Oh, yeah. The analysis points to things like the U.S. stock market reacting negatively when new tariffs are announced. That reflects investor uncertainty and worry.
Sure. Nerves about the economy.
Exactly. And growing concerns about inflation, which we've all felt, and the potential for slower economic growth overall. There was even data cited comparing price increases.
What did that show?
It suggested that U.S. prices rose quite a bit faster between 2017 and 2025 compared to the decade before that, like 2005 to 2016, highlighting that inflationary pressure has definitely picked up.
And who feels that inflation the most?
Well, as the analysis rightly points out, rising prices tend to hit lower-income families the hardest. They spend a bigger chunk of their budget on necessities.
Right. Okay, so inflation is one impact. What about the idea of reshoring, bringing manufacturing back to the U.S.? Is that seen as a viable alternative?
The analysis suggests it's challenging, very challenging.
Why? What are the hurdles?
Several big ones. Finding enough workers with the right skills is one. Labor costs are generally higher in the U.S. than in China or Southeast Asia.
Okay.
And then there's infrastructure. Do we have the right ports, roads, energy grids, factory spaces ready to support a massive return of industry? The analysis suggests maybe not, or at least not without huge investment.
So it's not just flipping a switch.
Not at all. It
Right.
would require enormous amounts of capital, time, and also, crucially, a consistent political will to see it through over many years. And, political consensus can be hard to come by.
Understood. Now, this whole situation, it's not just a U.S.-China thing in a vacuum, is it? How are U.S. allies getting caught up in this?
Yeah, that's a really important to mention. U.S. allies are definitely feeling the effects and facing tough choices. Take Japan, for example.
Right.
They've been trying to diversify, move some production to places like Southeast Asia to reduce reliance on China. But the analysis shows that even with those efforts, over half of Japanese companies still depend on China for critical components, things like electronics, car parts, machinery bits.
So even when they diversify the final assembly, the guts still often come from China.
Often, yes. And adding to the complexity, Japan itself has faced U.S. tariffs on things like steel and aluminum, which obviously doesn't help the relationship.
Right, creates friction with allies too.
Right.
What about Europe? The EU?
Similar story, similar dilemmas. China is the EU's single biggest source of imported goods, something like over 21% of everything they bring in.
That's a huge chunk.
It is. And there's a particularly acute dependence highlighted in the analysis, electric vehicle batteries.
Yes, the future of cars.
Exactly. And China basically dominates the global market for EV batteries, controlling around 70% of it. 70%.
Yeah. So the EU is in this really tricky spot. They want to build up their own EV industry. They want to be less reliant on China strategically. But right now, they heavily depend on Chinese batteries to make it happen. It's a major contradiction they're grappling with.
It sounds like these tariffs, the goal might have been to weaken or contain China, but maybe there have been some unintended consequences, maybe even strengthening China in some ways.
That's a really interesting argument that comes through in the analysis. The idea is that while the tariffs certainly create problems for China, they haven't stopped China from pouring massive investment into strategic, future-focused industries.
Like EVs, robotics.
Exactly. EVs, robotics, solar panels. Think about their big Made in China 2025 initiative. The goal there is to become a world leader in all these high-tech fields.
And the tariffs haven't derailed that ambition. Doesn't seem like it, according to this analysis. China continues to push hard in those areas. So the argument goes the tariffs might end up just raising costs for U.S. consumers and businesses, making us less competitive without actually stopping China's progress in these critical sectors, might even spur them on faster in some cases.
That's a sobering thought. So where does all this leave us? What's the bottom line? Feels like a bit of a stalemate.
Stalemate is probably a good word for it, yeah. That's the sense you get from the analysis. Short-term negotiations, unlikely to fix the fundamental disagreements.
Because the core issues are still there.
Right. The U.S. is still deeply concerned about China's economic power and the trade imbalance. But at the same time, the U.S. finds it really hard to quickly rebuild its own manufacturing or truly decouple from China's supply chains.
And meanwhile, China's made itself less dependent on the U.S. market anyway.
Exactly. So the core differences run deep. They're structural, almost philosophical about economic models. The analysis suggests we should probably just expect trade tensions to be a feature, not a bug, of the global landscape for the foreseeable future.
So the idea that tariffs alone could fundamentally change things or weaken China significantly,
Yeah.
maybe that wasn't realistic.
The analysis leans that way, that tariffs used in isolation haven't really achieved those grand objectives. And as we discussed, they've come with side effects like straining relationships with key allies.
Which isn't ideal either.
Not ideal at all. So the takeaway for businesses, for policymakers, is probably buckle up. This friction isn't going away quickly. Need to plan for continued uncertainty.
Okay, so let's try to wrap this up. Key takeaways. This whole trade picture is way more complicated than just headlines about tariffs.
Definitely. It's deeply rooted in competition over global influence, economic models, national security concerns.
And China, despite all the pressure, has shown remarkable resilience, partly by strategically shifting its economy.
And leveraging its manufacturing scale and efficiency? Yeah, they've adapted.
And the impacts aren't just confined to the U.S. and China. It's a global thing, affecting allies, supply chains worldwide, and ultimately filtering down to, well, to you listening, likely through the prices you pay.
Absolutely. Remember that first point we made, that weird fact about exports rising right after tariffs?
Yeah, the head scratcher.
It makes a bit more sense now, right? It shows just how complex and interconnected this whole global trade system is. There are no simple on-off switches. Actions have ripple effects, sometimes unexpected ones.
Right. It's a web, not a light switch.
Precisely. And that leads to maybe the final thought to leave people with. Given how deeply intertwined everything is, with China playing such a central role, what would real economic decoupling actually look like? Is it even possible?
And maybe more importantly, who pays the price for trying? What does that mean long-term for innovation, for competition, for the choices you have as a consumer?
Those are the big lingering questions. Definitely something to chew on.